Hi, everyone. I'm Adele Goldberg. I'm the Executive Director of Friends of Yad Sarah here in New York. And welcome to our first Planned Giving webinar. This is part of a series that we're doing to get out in front of our friends in the digital universe in the United States and tell them about what's going on with the Yad Sarah organization and how they may be able to help. This is going to be a unique session because this is not going to be just about what you can do for Yad Sarah, but also what your participation with Yad Sarah can do for you as well. I think as many of you know, Yad Sarah is the largest volunteer staffed organization in the state of Israel, best known for lending out durable medical equipment. But we also have a spectrum of about 20 different services along the continuum that includes accessible transportation, day rehabilitation services, homebound outreach, oxygen concentrators, wheelchairs, home hospitalization, and certainly during these COVID times, Yad Sarah has been instrumental in helping people to take a timely hospital discharge to make sure that the hospitals have room to treat the seriously ill COVID patients. So we're able to set up home hospital units in their own home, which is where I think we all want to be anyway when we aren't feeling well. We are pleased today to be able to present to you our Planned Giving expert, Neal Myerberg, who's been working with us for several years. And we're going to be talking about a popular program, which is our gift annuity program. And I'm going to turn the program over to Neal and let him get started and explain how the program works and how this can benefit the organization and you as well. If you have questions in the interim, feel free to submit them during the chat, on the chat feature on Zoom, and Neal will answer your questions during the course of the webinar. So I guess without further delay, Neal, take it away.
Thank you, Adele, and welcome everybody. I hope you're all in a comfortable place and doing well. You can tell by the screen I have here, I'm going to share this presentation with you. And as Adele mentioned, if you would send any questions you have from point to point through the chat universe, she will receive the questions and she'll route them to me. I'm going to hopefully get questions throughout as opposed to at the very end, and I welcome you to participate. You can see the title of this program, Predictable Income When You Need It Most, and it's more and more relevant now, as you'll probably see, because people are struggling with fixed income. People are struggling with any number of scenarios. And in this case, we're hoping to show you some options in which you can partner with Yad Sarah to get results. So let's take a look at some reality here. I made the comment on this slide, why is it challenging now to secure safe fixed income at reasonable rates? Well, we all know the interest rates are close to zero right now. In any kind of money instrument, whether it be a savings account, a money market account, a CD, and even when I've created this slide, it hasn't changed much. Rates for treasuries are 0.09% to 0.17%. I mean, so low on T-bills that mature from 4 weeks to 52 weeks. So you can see these rates are almost zero. And I don't know any way you can do anything beyond that, because if the Fed and the IRS discount rate is this low, which is 0.4% for September, and it will be the same for October, it suggests that there is no yield out there. There are, in fact, deep discounts to yield. So I'm pointing out that interest rates are low. I'm pointing out also the IRS discount rate is very low. The discount rate, what is also called the applicable federal rate, is the rate that is used to calculate gift annuities and other kinds of life income plans, and it impacts annuity rates, and it impacts, more importantly, how much tax-free income you get. So I'm saying here, those of us who would like to get additional return in this difficult environment would have to go out and take risks. You have to buy corporate bonds. You'd have to buy any number of things that would enable you to get income while protecting capital. And when people are older or retired, they don't want to take risks. The fact of taking risk is one thing you don't want to do unless you have to. And risk means anything other than something that locks in a rate and is insured or protected by federal or state regulators. And lastly, as you can see on the bottom, the Fed chair on August 27th and said it again since then, said that the Fed will not feel obliged to raise interest rates even if inflation sets in. They're even saying even in a full employment economy, they won't raise interest rates, which I think is very, very interesting because usually the Fed raises interest rates when it's trying to control inflation. And inflation might be something to be relevant if people's jobs become restored and unemployment rates go down. The thing I don't have on here was a comment made by Goldman Sachs on very recently, I don't have the exact date, in which Goldman Sachs said they think, it's their prediction, that interest rates won't move and the Fed won't move to maybe 2025. So if interest rates are going to stay low between now and 2025, and even then might not go very much, what do? How do you get returns? And then maybe you have to think about this investment you make with charities like Yad Sarah to acquire an annuity under the rules of charitable gift annuities, which are regulated by states and also have federal regulations to it. And by doing that, find a way to get more return and to get it safely. You can see on this screen, a gift annuity is simply a transfer by you to a charity that has the authorization under state law to issue gift annuities of cash or generally regular, publicly traded securities, in which you set a rate based upon the tables, and it's a contract. You make a contribution, and the charity in the contract says, in exchange for your contribution, we will pay you the sum of is what is the variable, the sum of, for the rest of your lifetime, or the lifetime of you and one other person. Gift annuities can only be for mostly 2 lives. They can't run for years, they can only run for lives. And the rate is based upon life expectancy, which means it's based upon people's ages. So in the benefits, you receive fixed income for life. At this point, any rate would be extraordinarily higher than the rates you're getting on fixed income anywhere else. You'll get more yield, obviously. For those of you who itemize, you'll get an income tax charitable deduction for a portion of that gift. And lastly, I'm going to show you this in more detail, a portion of your annual annuity payment is tax-free. So you get a tax deduction, you get a high rate, you get tax-free income, and I think probably important to all of you is at the end of the term of the annuity, which means at the end of the life or lives in the annuity, whatever remains, which is called the residuum, otherwise known as the remainder, goes to Yad Sarah. So you're buying an annuity from a charity as opposed to from an insurance company, and you get benefits because it's being bought from a charity that you wouldn't get otherwise. What kinds of annuities are there? There are 2 different kinds, essentially. There's an immediate annuity, and there's a deferred annuity. An immediate annuity means if you buy the annuity from Yad Sarah now, and we calculate the rate now, and we calculate the tax deduction, and we calculate the tax-free portion, the annuity begins at the time the contract's signed, which corresponds with the time you make the contribution. That's pretty easy to understand. 1 life or 2 lives using cash or cash equivalents. Sorry. And you can use securities. Now, deferred annuity is interesting because you might be of an age where you don't really want the income now, but you want to lock in a rate of income for a time in the future, maybe at the time when you're going to retire. So you might create a deferred annuity now. Perhaps you're 60 plus and you don't really looking for the money till age 70 or 72, corresponding with when you have to take money out of your qualified plan, and maybe corresponding to when you start taking Social Security. So you have a deferred annuity, which starts in the future. We set the date. But what's interesting is what I've written here. That deferred annuity may have a flexible payment plan, which means that if you're predicting you're going to retire at 70 and your annuity is calculated to 70, we're going to have a schedule in your agreement which shows what your rate would be and what your payments would be if you waited any one of 15 years beyond age 70, thus to age 85. So if you get close to age 70 and you say, I don't really need the income now, I'd rather start the income at age 75, there'll be a schedule already attached to your agreement that says what your payments will be at age 75 or age 80 or age 85. So it gives you the flexibility of saying, I'm going to decide later on when I'm going to take my annuity. So two types, immediate and deferred. Some interesting facts to pay attention to as we go through some examples. Your age to your nearest birthday. And that's important because sometimes people will say to me, would you calculate my gift annuity for me on the basis that I am now age 75? And I'll say to myself and thus to them, well, you might not be 75. And their comment would be, what do you mean? I know how old I am. Well, you are your age to your nearest birthday. If your nearest birthday is within 6 months, less a day, to the next age, you are your next age. And why you want that to occur is because the higher your age, the greater your age, the higher your rate. So sometimes, for example, I've just did a calculation recently for someone whose birth rate is April 22nd. So on October 22nd, actually maybe make it more generous, October 25, he or she will be within 6 months of April 22nd next year. So not to do a gift annuity now makes sense. Do it no earlier than October 25. So we look to know what your age is to your nearest birthday. Number two, and this is a difficult concept to understand, but I'm going to express it based upon IRS practice. Two life rates, husband and wife, couples, partners, siblings, parent, adult child. Two life rates are always lower than the rate for the younger person. That's kind of curious. For example, if two people are both age 80 and each of their individual rates were 8% under the tables, and they decided to do a gift annuity jointly, you would think, why wouldn't the rate be 8%? Because they're both 8%. And the point is, two lives go longer in duration based upon actuarial charts than each life individually. So the annuity is going to be predictably longer, and so the rate will be lower than the rate for the younger person, thus lower than 8%. I'll show you an example, but two life rates are not simply taking both individual life rates and getting the rate for the two of them. It's based upon other factors. Number three, if you contribute other than cash, you contribute capital gain property like stocks. You own a large position in perhaps Microsoft, and you say, well, maybe I'll use some of that for my gift annuity. You can do that. However, by doing that, some of the capital gain, I say some, not all, but some of the capital gain is taxable to you because a gift annuity is part purchase and part contribution. The purchase portion is a capital gain taxation issue. So what happens then is, in each of your annual payments, you'll get a breakdown of how you pay tax. Some of it will be ordinary income, some will be tax-free income, and some will be capital gain income. It's almost like an installment sale. Your capital gain that you realize when contributing some stock for a gift annuity, not all the gain, but some of the gain, it's going to be charged to you year by year for your life expectancy, which makes it much softer. And lastly, if you outlive the tables, one of you or two of you, you continue to be paid. You don't stop getting payments just because you reach life expectancy. You get paid for the rest of your lifetime. And oftentimes people do outlive life expectancy and they continue to be paid. Now we're going to talk about capital gains. We just did an example and how deferred gift annuity plans work. We're going to talk a little bit about IRAs and other qualified plans and rates for two life gift annuities. Let me make an important comment. Those of you who have used your IRAs for your charitable giving, if you're over at some point 70 and a half or now 72, and therefore use some of your required minimum distributions by making gifts straight to charity, called an IRA charity rollover, for example, as you saw here, you weren't paying tax on those dollars coming out of the IRA when they were going to charity. However, you would have to pay tax on those dollars if you took them out to buy a charitable gift annuity. It's part of the regulations. So therefore, most people don't use IRA money to buy charitable gift annuities because they have to pay tax on taking the money out, unless they had to take it out anyway, which is the RMD rules, in which case it may calculate well, but I want to point out that it's not something that people normally do. Examples, and this is where we can really get into some understanding of how these things work. And I've done it at different ages and different information. In each instance, I'm using $10,000, which is the usual minimum contribution for gift annuities, to describe each of these scenarios. Here I have a donor, individual age 70, male or female, gender neutral calculations, whose life expectancy under the tables is 15.9%, expected to live to almost 86. And that donor has $10,000, perhaps in a CD that came due in the bank, doing nothing, and says to Yad Sarah, I'd like to contribute $10,000 to buy a gift annuity, but I need to know what I get as a consequence. So we do the calculation, and we find the following. That $10,000, based upon tables age 70, is going to pay a lifetime rate of 6.5%. And 6.5% times $10,000 means that that individual will get $650 for the rest of his or her life, irrespective of market performance. In addition, because this person has a charitable contribution embedded in this, at the time this is done, because discount rates are so low, the charitable deduction is about 12.2% or $1,221 of the contribution. It's low because the discount rate is low, but it's going to show up to be something better for you as I go through this calculation. So therefore, here's your income tax charitable deduction if you itemize. If you're paying taxes, federal and state combined, or in some states you don't pay state taxes, federally alone, and your marginal rate is 25%, that tax deduction will save you that much in income taxes. Therefore, if you subtract this amount of tax savings from the $10,000 you put up, your annuity is only actually costing you $9,695. If you divide that into your payment, your rate of return is 6.7. So far, so good, particularly if you itemize. What's happened now as a consequence of the low IRS discount rate is that for the first 15.9 years, the life expectancy of your annuity, almost 85% of it is tax-free. It's never been this low historically. Never had a rate this low historically, the IRS discount rate. Thus, we've never had a tax-free portion this high historically. And I'm talking about over decades. It may only continue if the IRS discount rate stays low, and that's going to be a function of interest rates and markets, particularly treasuries, because that's what the rate reflects. So right now, a substantial rate of return for life for this person, a tax deduction, and a substantial tax-free portion. Now that's age 70, 15.9 years. Let's look at age 75 now. Same scenario. Different individuals now has a shorter life expectancy, 12.4 years. Now, look, what's interesting here is this individual is expected to live to be age 77.4. The older you are when calculations are made.
87.4, you meant.
It's just the nature of the calculation table. So in this case, he or she gives $10,000 by contribution to Yad Sarah, and we find out based upon the tables that the rate will be 7.1%. Age 75, the rate is higher because the person is expected to live longer. So live shorter because the person's older. So the payment's going to be $710 a year for life. The tax deduction is larger than in my 7-year-old because the person will live a shorter period of time. So charity will get their money apparently sooner. That tax deduction is, if you itemize, going to save you at 25%, $614 in taxes on the return you file for the year of the contribution, which reduces your costs and increases your effective rate. And look for the example here. Your tax-free portion over life expectancy of 12.4 years is almost 86%, 85.7%. The older you are, the higher your rate. The older you are, the larger your tax deduction. The older you are, the larger your tax-free portion. And again, this tax-free portion is significant. If one were to look at these calculations and say, what would be my return if I had to pay full tax? What would be my real rate of return if I had to pay tax and not had to and avoided tax by almost 15.3%? It would be that this rate would be considerably higher. But in this instance, these are the numbers we have. The rate, the tax deduction, the tax-free portion. All this suggests that age 75, the numbers are better because age 75, the donor is older. Both of these examples are made with gifts of cash. Now, let's talk for a moment whether you make a gift of stock. Same age 75. Now, here's what I'm doing here. I'm showing the same value of gift. However, it's being made with appreciated capital gain property with a basis, you can see here, of $4,000. basis, you all know, means what did the stock cost you when you bought it many years ago? If you were selling it tomorrow, you have a $6,000 capital gain to pay tax on. That's if you sold it outright. But you're checking in with Yad Sarah to say, can I do a gift annuity using appreciated securities with $10,000 where my gain is $6,000? Can I give the securities to you, Yad Sarah, to acquire a gift annuity for the same $10,000? And we're assuming the valuation of that stock for this purpose is $10,000. Same age, same life expectancy, same contribution, same tax deduction, same rate. So here's the contribution, the stock value, $10,000. Here's the rate. He or she will receive $710 a year, just like my other example using cash. Same tax deduction, $2,455. Same tax savings, same net cost. And line 7, same effective rate, which is your net cost divided into the payments you're going to be receiving. Your payment is based upon $10,000, but the annuity is not costing you $10,000 because you're saving $614 in tax. So up to this point, we have the identical page to what we had screened before for one life gift annuity, donor age 75. But because there's some capital gain in here that is attributable to the purchase price portion, not the whole $6,000, but some part of it, when we do the calculations of how you're going to be paid every year and how you're going to be taxed, we've taken away some tax-free income and instead had to tax you at capital gain income because we have to pay tax on the gain over 12.4 years. So every year, an annuitant or annuitants get a Form 1099-R. You know what 1099s are. This is a 1099-R. R essentially stands for retired. And that form said, receive $710, of which 34.3% is not taxed, 51.4% is taxed at capital gain rates, which are almost always lower than ordinary rates, and 14.3%, the same as on my prior screen, is all that's taxed at ordinary rates. So if you added 51.4 and 34.3, you get 85.7, which is exactly what the tax-free income was on the prior screen because the donor used cash. So you may wonder, does it make any sense ever to use appreciated securities to create a gift annuity? Well, people do it all the time. What they're doing is they're paying some tax on the gain, but not in one swoop. They're paying it over a period of time in their annuity payments, not out of their purse. And so therefore it's softer. It is over a period of time, so that's its installments. And although it's not as good as having tax-free income, it's certainly a better tax rate than having ordinary income. So in example 3, we've got someone using what we call capital gain property, securities, publicly traded securities, to create the gift annuity. So far, what have we done? We've taken an 870 individual, and we've shown how that annuity is priced out based upon rate, 6.5%, and based upon tax deduction, and also based upon how much tax-free income they've gotten. We've shown a 75-year-old using cash as well, where the tax deduction is larger because life expectancy is shorter, yet the tax-free portion is higher, and the tax deduction is higher. And we've shown a 75-year-old, same life expectancy, using stock instead of cash, in which some of the payments are going to be made to him or her at capital gain rates, but still a substantial portion is made at tax-free contribution distributions. So these are 3 examples. But I want to show you something. Pay heed, of course, to my 75-year-old and life expectancy. And look now at my 2 live scenario. Donors 82 and 80 were saying, well, you know, we would like to create a 2-life gift annuity, but we don't know how it calculates because at age 80, my rate, the younger person, is 8%. Older person, 82, the rate would be close to 8.3%. Why is it that our rate isn't a blend of these 2? And we point out that the life expectancy of the 2 of you together is almost the same as the life expectancy of a single 75-year-old. Very interesting IRS mathematical calculations. The actuarial tables say that these 2 people together will live almost as long as the individual age 75 will live as one life. So therefore, the $10,000 that's used to buy the gift annuity for ages 82 and 80 has the same rate than the rate for the age 75 because life expectancy is almost the same. So let's see what happens. $10,000 in cash to Friends of Yad Serah. Contract executed. Rate 7.1%. $710 payment, just like the 75-year-old. The tax deduction, the charitable deductions are a little bit higher than for the 75-year-old because these individuals are going to live a little bit shorter than the 75-year-old based upon the tables. They may live longer, they'll still get paid, but this is what the math is based on. They'll save a little less tax, they'll have a little bit higher net cost. But look at this, their tax-free portion is almost the same as the 75-year-old, 87%. So for 12.1 years, 87% of their payment is going to be tax-free. At the end of 12.1 years, if one or both of them are still alive, they still get paid at the full rate, but anything that's tax-free has already been recovered. They then pay tax at ordinary rates, but they're also then considerably older. So this is how the IRS math works so far. A current gift annuity is a function of age, thus a function of the tables of rates, and is a function of the IRS discount rate. We calculate these things for the month of the gift, and by law, we can choose the most favorable gift, the most favorable discount rate to use for you. Now, what does that mean? We can look back 2 months or look at the rate for the month of the gift, choose the one that's best for you, choose the one that gives you the highest tax deduction, choose the one that gives you the highest tax-free portion, and when you get your calculations and file your return, you will then be able to take advantage of the discount rate that's best suited for you for the year. Right now, in September, the discount rate is 0.4%, 0.4%. For October, the prediction is it will also be 0.4 or 0.4%, which means these numbers I'm showing you here will carry further. The younger you are, the lower the rate. The higher you are, the higher the rate. So this is examples of current annuities. Let's talk for a moment about a deferred annuity. This is a little bit more complicated to understand, but we're going to walk ourselves through it. Here's an individual, age 60, whose life expectancy is 25.9 years, rounded to 30. So you see the life expectancy is considerable. Sorry. She's expected to live to 85, almost 86 years of age. Using $10,000 and says to the charity, I want to acquire a gift annuity, but I don't want payments to begin until I'm 70. But can I do it now? And by deferring the payments, can I leverage a higher rate? Again, it's a function of the IRS discount rate. It's a function of the duration of delay of the deferral period. So we do the calculations. Let me point out one piece of law here. The tax deduction for a charitable gift annuity can never be lower than 10% of the amount of the contribution. So mathematically, if you make a contribution of $10,000, your deduction's got to be at least $1,000. With a low discount rate, we have to adjust back some rates to get that deduction. So in this case, I had to adjust the rates to get a deduction, a present deduction of just about 10%, $1,092. It's just because that's what the low interest rate environment makes us do for gift annuities and any other income instrument that you want to deal with, both charitable and non-charitable. And so we make a contribution of $10,000. We set the payment to be in 10 years, and the payment will be based upon a rate of 8.2%, which means he or she will receive $820 a year for life, beginning at age 70. This tax deduction is available at the time the contribution is made, even though the annuity doesn't start for 10 years. And you can see the deduction is very close to 10% of the contribution, which will save some taxes if you itemize. It'll decrease your net costs and increase your rate. And at age 70, when he or she begins to receive payments, 68.3% of those payments will be tax-free. We know them, even though the payments won't begin until 10 years, we know that now. We know because we can calculate all this right now based upon current interest rate environments, current discount rates, and this contract signed between the charity and this donor locks all this in. It doesn't deviate. It isn't variable, doesn't get changed because rates may be higher or lower at age 70. So all these numbers are known at the beginning. I point out at the very bottom about a flexible DGA, deferred gift annuity. And that is, when you do a flexible, even though she has thought to do at age 70, she was going to begin at age 70, we will still calculate for her, for him, a schedule of what she or he would receive beginning at age 70 and going to age 85, so that when age 70 arises but doesn't get quite there, the election could be made to say to the charity, the Yad Serah, don't begin my annuity until age 75, and I understand my payments at age 75 at the time of my retirement will be X. X will be set out so people don't get surprised. It also gives a person the opportunity to say, well, I thought I needed payments at age 70 when I did this, but as I get closer to 70, things have changed. I don't need them that much anymore. I can wait till 75. I'm feeling in good health. I may even continue to work for a while. So therefore, we can calculate that today for decision-making tomorrow. So let's talk about annuities in the context of something equally as important. How do you feel secure when acquiring a charitable gift annuity from a charity? This is a very important question. Some of you may be checking into this webinar from states other than New York, from states other than California, from states other than New Jersey, where the regulations are pretty stringent to protect annuitants. Some of you may be checking in from states that have no gift annuity regulations whatsoever. The reason why regulations are important is because in states that are highly regulated, like New York, there's a requirement, much like they would ask an insurance company, to create a reserve account. And that reserve account is segregated, which means it can't be used for anything other than the payment of annuities, can't be used for operations, can't be used for programs. And that reserve account has to reflect all the money needed to pay each annuity based upon present value calculations. And with respect to New York, a surplus of 26.5% above that number to assure people that if something happens to the charity, unlikely because most charities who do gift annuities are substantial, something happens to the charity, there will be a reserve account that can be drawn upon to pay the annuities. New York, New Jersey, and California have these substantial regulations to protect annuitants based upon a reserve account in the state of New York or New Jersey and a reserve trust in the state of California. So people ask, how can I know that Yad Serah is going to pay me? Maybe the rates will be such that they can't. Well, that's because the annuity account reserve protects you. The second question people ask is, well, if I'm 70 years old and the rate is 6.5%, and the world right now, total return from investments of bonds and equities is 5%, for example, or 4% at the moment, how does Yad Serah pay me 6.5? So I explain it this way. The calculations for gift annuities presume over normal life expectancy that the charity is going to receive 50%, 50% of your contribution at the end of your lifetime. Not 100%, 50%, because the charity is going to have to use some of your capital to pay your annuity, particularly if they can't earn to the extent of the annuity rate they're paying you. So that's all built into the calculation. So the worry people have is, can I get paid? And if I'm going to be paid, how do you pay at that rate? It's all covered by the regulators of states like New York and California. Last thing to point out, if you're in a state that's not regulated and you wonder, how am I protected? If you acquire a charitable gift annuity from a charity that's registered and regulated in New York, like Yad Serah, or California, or New Jersey, and you buy it from that charity, even though you may be in a state that's not regulated, the rules of New York apply. The contract actually says, this contract is executed in the states of New York and your state. It shall be governed by the laws of your state, if there are any, and to the extent that there are laws in your state that aren't as stringent for the state of New York, laws of New York provide and prevail. So you're really protected with gift annuities. I'm not sure if there's any questions. I'm going to go on, but if Adele has any questions from you, she's going to ask them of me.
There's no questions yet, but I want to remind our guests that you can use the chat function to submit questions for Neal, as they occur, and he will answer them.
The second thing I want to talk about is called a charitable remainder trust, another life income vehicle that people make use of. It's different than a charitable gift annuity because it's a separate trust. It's usually funded with appreciated assets, not with cash. It's a different calculation scenario for determining the rate. And it allows you to have multiple charities if you choose to be the beneficiary at the end. Whereas with the gift annuity, the charity who issues a contract with you is a charity that gets the benefit. So let's take a look at this. Here's my 75-year-old again, same life expectancy, and here's her scenario. She has stocks in a portfolio, not an IRA portfolio, but in a personal portfolio worth $250,000. And her cost basis is $50,000, which means she's got a pretty substantial gain here of $200,000. The financial advisor says to this individual, I think you should sell those stocks. You've had a lot of good run with it and invest more cautiously, maybe more in fixed income, a little bit less in stocks, and sort of protect the asset as years go on. You're 75. We hope you'll live for a long time, but you're taking risks. And the donor says to the advisor, well, all well and good, but if I sell these stocks and pay tax on a $200,000 gain, I'm going to have much less than $250,000 left over. And what do I do then? Do I buy a money market account? Do I create a CD? There's nothing out there. Do I invest in stocks? Well, I'm in stocks already. What are you offering me as a choice? Well, here's what the advisor might suggest. Take these stocks, contribute it to your own new irrevocable trust called a CRAT, Charitable Remainder Annuity Trust. You can be a trustee if you want to. You can ask the charity to be a trustee, a trust company can be the trustee, a family member, a professional advisor, but it's a separate trust. If you transfer this stock to this trust and the trust sells the stock, there is no tax on the gain at time of contribution. So therefore, we now have liquidity of $250,000, which the trustee is going to invest to pay a rate of return for the donor for life. Because the discount rate's so low, and it impacts gift annuity rates, but particularly charitable remainder trust rates, the rate for this individual would be 5.5%. The rate can never be lower than 5% by law. So therefore, with younger people in their young to middle 60s, you can't use a charitable remainder annuity trust because we can't fix a rate at 5% because we can't pass various IRS tests. Too complicated, just understand. There are tests that the IRS imposes to be certain the rate will qualify. For 75-year-old, the rate can be 5.5%, and this donor will get 5.5% times 250 or $13,750 a year for the rest of life. In addition to which, there's a substantial income tax charitable deduction. It almost looks like almost 50% of the contribution is deductible. An itemized deduction for those of you who itemize. If you don't itemize, this may give you a reason to itemize. And that deduction is available to you for the year of your contribution. If you can't use it up that year, you can carry it over for year by year for an additional 5 years. So you will ultimately, hopefully, use up your tax deduction. So let's see what happens here. Stocks contributed to this CRAT. The stocks are sold, and we now have in the charitable remainder trust $250,000 in cash. The rate's fixed at 5.5% by IRS rules, not based upon tables rates, by IRS rules. The donor will receive $13,750 a year for life. An income tax charitable deduction of $120,548, which, if there's a 25% marginal rate, which means federal and tax margins combined, will save this much in tax, better than $30,000, which reduces the cost and increases the effective rate. Now, remember on the gift annuity pages, we could identify exactly how it's taxed. Some ordinary, a lot tax-free, maybe some capital gain if you're using capital gain property. We can't predict that with a CRAT or any charitable remainder trust. It's always known at the close of every year when the trustee reconciles how earnings occurred. Some of it would be interest, some dividends, some capital gain, some principal return perhaps, and issues to you a Form K-1, an IRS Form K-1. The K-1 shows exactly what you have to report in your tax return that year and in what category to show tax or no tax, if possible, show tax on your $13,750. A charitable remainder annuity trust is almost like a charitable gift annuity in that the rate is fixed at the beginning, the payments are fixed at the beginning, they never vary through your life or lives, depending upon how many people are annuitants. Other than that, a gift annuity is almost always funded with cash, can be funded with appreciated property, however, and charitable remainder trust almost always funded with appreciated stocks, other kinds of assets, in order to get rid of this long, large capital gain that I showed you here that she was trying to avoid. There are two types of charitable remainder trusts. We just talked about one. The second type.
Neal, before you move on, there's a question from one of our guests.
Okay.
The question is, can an annuity begin at death where the annuity is set on the lives of two people? What will the numbers be in this example?
Let's see if I understand the question. You create an annuity now, a charitable gift annuity now, but you don't want it to begin until the end of the lifetimes of two people. Who would be the beneficiary then? I'm not quite sure I understand the question. So Adele, you want to read me the question again? I'm not sure if I understand it.
It says, can an annuity begin at death where the annuity is set on the lives of two people?
Okay.
What will the numbers be in this example?
Okay, guess what maybe I'm understanding is somebody might create in a will a gift annuity to begin for someone else at the end of the creator's lifetime. If that's the case, that certainly can be done. The trouble is we can't predict the rate because we don't know what the age of the people will be, because we don't know how long the person who created the gift annuity by will live. So what the language in the will generally says is, I give the sum of X dollars to create a charitable gift annuity for my son and daughter. I direct that the gift annuity shall be at the rate then in effect for the charity as filed with the regulators in the state of New York, and that rate shall run for both their lifetimes. That is the way it's done, because we can't know that rate until the date that the gift annuity is going to be established. Essentially, we don't know it until the end of the lifetime of the person creating the gift annuity by will. I hope that's the answer to I hope that's the question that was being asked. So let me talk about the charitable remainder uni trust for a second. This is the trust that we use to receive assets that are generally illiquid, like real estate or work of art, or sometimes liquid assets for somebody who wants to take some market risk and get some market reward. Remember, in the CRAT, you fix a rate, nothing ever changes, like a gift annuity. In this case, here's my example. Say a 75-year-old has some stocks or piece of art or real estate worth $500,000 with a cost basis very low with a gain of $450, who says, you know something, I really need to contribute this or get this out of my name, and I don't want to sell it because the capital gain is so large. Can I put it into a charitable trust and still have the opportunity to share in some market appreciation of my trust as time goes on? Or can I put a piece of art or real estate in my trust knowing it can't be sold immediately? The answer to all that is yes. Let's look at how it's done. In this case, the stocks worth $500,000 are sent to the trust to fund a uni trust, and the rate for the uni trust for the same age person is higher than the rate for charitable remainder annuity trust. The uni trust rate is higher because the trust is going to adjust every year. So we fixed the rate in this case at 7%, as opposed to 5.5. 7% times $500,000 because we've sold the asset, realized proceeds, didn't have to pay the tax on the gain then. We're going to pay this person $35,000 a year for the rest of life. There's a substantial tax deduction of better than half the value of the contribution, which if this person is an itemizer will save a substantial amount of tax, reducing the cost and increasing the rate. But let me give you the details of a charitable remainder uni trust, which are not on the screen. And that is, that 7% rate never changes. However, at the end of the calendar year or at the end of the first business day of the next year, the trust is revalued after making its payments to you for the year just before. And that 7% multiplied by the new valuation will determine the payment for the next succeeding year. So if the trust has gained value, it's no longer worth $500,000, maybe it's worth $520,000, the payments for the next year will be based on 7% times 520 or 530 or 540. If the trust lost money, it's now worth 450. The next year, your payment's going to be 7% of 450. So there is some issue about assets going up and down. Some people like the idea of participating in the market, thinking that over time the market will be beneficial for the trust and they'll get a higher payment year by year to cover inflation. Some people don't use the unit trust because they're afraid of market changes. They'd rather have a lower rate, but a trust like the one on the prior screen where they're going to get paid irrespective of market performance. The second thing to be aware of is sometimes you'll contribute an asset to a unit trust that isn't immediately liquid. It may take some time to sell. While it's pending sale, there's no liquidity in the trust, so the trust can't pay you your payment. However, your payment is not lost. It goes into a makeup account called a bucket. That makeup account is like a deferral account. If and when the property is sold in the future, hopefully for more than its initial value, to the extent of the excess after paying the unit trust amount for that year, we can pay you the money that's been deferred. The bucket money comes out and you no longer have to worry about the accumulation because you got paid for it. It's called a net income unit trust. I know it's complicated. I appreciate you may be hearing this for the first time. The reason for this presentation is for you to know about these things and have access to this information. I'm sure you probably are interested in knowing, can I get a copy of this presentation? Will there be a recording of this presentation? The answer to the latter is there is a recording. And the answer is also, at your request, you can receive a copy of this presentation deck so you can see all this a second time. And you can always call in and speak to me or to Adele in confidence and follow up with questions, or you can also provide us with a date of birth or dates of birth information in confidence to see what the calculations would be for either a gift annuity or a charitable remainder trust or both. A couple more comments as we get close to the end. There are two tax acts that occurred in 2020 effective now and maybe will be effective going into next year, we don't know. One's called the CARES Act, CA. One's called the Secure Act, SA. Under the CARES Act, for those of you who don't itemize, you're going to still be able to write off $300,000 of your charitable, $300, I wish it were $300,000, $300 of your charitable gifts as a above the line reduction of income. So in effect, you're reducing your income by $300 on your tax return if you're a non-itemizer, because you're getting some deduction even though you don't itemize to this extent. Number two, the CA, the CARES Act says, for those of you who make charitable contributions in 2020, to the extent of gifts of cash, you can deduct them almost entirely as long as they don't exceed 100% of your adjusted gross income. That's important because the old rule was 60% of AGI. Now you can deduct up to 100% of AGI for gifts of cash to charities, including to Yad Sarah, including creating a gift annuity, including to your donor advised fund, including to your foundation, whatever it might be. Your deductions, if it's to a public charity, not to a private foundation, to a public charity, is 100% of AGI. These are new rules, beneficial for some people. Now, the rules for the Secure Act are not as beneficial. We now know that inherited IRAs or inherited retirement plans are going to be taxed much differently than they have been. Historically, you could have left to your heirs, your children, a retirement plan as an inherited IRA, and they would pay tax on it over their life expectancy, so it would be soft. They were in their 60s, their life expectancy 20-some years, there would be a factor every year of how much they had to take out, and that's all they had to take out. And they only pay tax on that. Now we don't have that anymore. Now they have to take it out within 10 years. So the government's going to get its taxes faster because they have to take out more quicker, and it's not what you planned. It's not what you hoped for when you had an IRA that was going to be inherited, and when I say IRA, any qualified plan, to the next generation. So there has to be some solutions And there are, and this is what the writers are talking about now. It's always been there, but it's never really been essential. And that is using the charitable remainder trust, whether it be the charitable remainder annuity trust or the charitable remainder unit trust. You can provide that the IRA get paid to that trust at the end of your lifetime, and that trust runs for life or lives of people, not just for 10 years. They will get paid for the life or lives at a fixed rate from that trust. At the end of the term of that trust, how many lives it runs, whatever remains in that trust will go to your charities. But when you create this charitable remainder trust with your IRA money, there's no income tax and no estate tax on your transfer from the IRA to the trust, because it's excluded due to the fact there's an ultimate charitable contribution. So I wanted you to know about that. And here I've narrated it all here for you on this slide about the standard deduction, the itemized deductions, and contributions. And I've also narrated the Secure Act, dealing with the fact that you might try to use your inherited IRA, can't be stretched anymore. Now it's 10 years. There must be some other strategy. I recommend that as you review your estate planning this year, if you have the time, most people are looking at it now because so many things have changed. Talk to your professional advisor, your lawyer, your accountant, your financial advisor, but how are you going to solve the issue of inherited IRAs that you hopefully would have been stretched, but now can't be stretched? So let me point out in closing a couple of brief things. This slide just shows you sample rates for Friends of Yad Sarah gift annuity. You can see the age in 5-year intervals, the rate based on IRS, the tables of Yad Sarah, and how substantial the tax-free portion is of the gift annuity based upon your age. And I've said here, it depends upon the month you create it and your then age and the IRS discount rate to tell us exactly what this number is going to be. But if you created a gift annuity this month or next month, at any of these ages or any ages interval, these are how high your tax-free portions are going to be. To close, these are difficult times for investors. These are difficult times for people who are retired looking for fixed income. Difficult times for people to take risk, particularly since we don't know what markets will do. The market for the past many days has given back almost all it gained since August, but yet the market as of August was doing fine. But you don't know that, and people aren't really ready to take that kind of risk. These are times to be thinking about what your will is saying, what your living trust says, what provisions you made for family, what provisions you made for charity. These are times to look at partnering with charities, in fact, investing with charities, to take care of your needs, both your economic needs and your philanthropic needs. Many of you who are on this call are people who already support Friends of Yad Sarah, and Yad Sarah is grateful to you. You cannot be any more grateful than the fact that your friendship and your loyalty keeps the work that's so important done in Israel. But now it's time maybe to look at what's good for you as well. And that's why I recommend to you that you take a no-risk step to check with the charities you support, particularly Friends of Yad Sarah, and ask for a calculation, ask for information, ask for it in confidence, and don't hesitate to keep on asking questions, because answers are important to you as you do your financial, tax, estate, and charitable planning. So Adele, I'm going to turn it back to you for some remarks and to...
I just have a couple of questions that people usually ask, which I'm not sure were addressed. How often can you receive the payments?
Okay, good. Most people take them quarterly. Some take them every half year. Some take them annually. And some, if they want, can take them monthly.
And I know that the money is deposited through direct deposit or is sent via a check in the mail.
People can make their own decisions. More and more people now are hesitant to receive checks and are having money directly deposited in their accounts at the bank. When you create a gift annuity, one of the forms you're going to get is a direct deposit authorization form. You fill it in with details. It's sent to the fiduciary agent for the program for Yad Sarah, which is PNC Bank. It's a very large bank that has a very substantial department that does only this stuff, and they will directly deposit it by ACH to your account, but you can get it by check as well. You make the call.
Could you go over again, Neal, if you would, about the reserve account and the security for payments being made to annuitants? I certainly know that we deal directly with PNC Bank and with the state of New York, who audit our program every 5 years, as they do every program every 5 years. And they have very strict rules and regulations. But I know that this is often a very big concern, is to make sure that these payments really are guaranteed. Could you just go over that point again?
Sure. To the extent I mentioned earlier, some states regulate this thing so substantially to be sure that you'll get paid. But let me take a step back. All charities can do this. You have to be a charity that has duration, long period of existence. You've got to be a charity that has a substantial independent resource of funds. You've got to be a charity that's given a permit by New York after going through a rigorous process. And you got to be a charity that creates the reserve fund and keeps the reserve fund current and substantial, because at the end of every year as of December 31, it's got to be calculated plus the surplus and reported to the New York regulators, for example, for approval or for review. So if you're an annuitant and you do business with a New York charity that can issue gift annuities, because all can't, those who can, that reserve account is principally important to you because it's going to be managed at PNC Bank. They're going to be the trustee. They're going to be the custodian of it. Friends of Yad Sarah is going to be, along with PNC, responsible for the payments. And to the extent, if it's ever possible, and I can't imagine a scenario where the reserve account is not substantial enough, which is hard to imagine because New York State is regulating this and watching it all the time, all the other unrestricted assets of the charity are also available for payments of gift annuities. So you want to know, who is a charity? Do they have a reserve account? Is it being invested and managed by an independent trustee? Is it following New York rules? Is it being reviewed every year? Is it being filed with the state of New York? If you know all that, you can be fairly certain that your payments are going to be made and fixed. The word guaranteed is almost applicable, but you hesitate to use any word like that. But to the extent of what New York State is doing, they're creating a reserve account with the charities to essentially guarantee the payments.
Friends of Yad Sarah has a reserve account as required by law, and our reserve account is overfunded. And we like it that way, just to ensure that we can guard against any market downturns and ensure that these payments to annuitants will be made without fail.
Yes, and I want to point out that I speak to PNC a great deal about many organizations that they manage assets for. They've always said, for those of you who would find this interesting, that Yad Sarah's program is so fiscally responsible because Yad Sarah, like many organizations, but not enough organizations, keep all of its gift annuity funds in the reserve, don't take them out for operations, even though they could take some out, because they want to be certain there's going to be everything there needed to protect their annuitants.
Yes, and at some point in the future, when the spread between the amount of money that's needed to guarantee payments for annuitants and the amount of money that's actually in the reserve grows large enough and wide enough, then at that point, the board can consider taking distribution to fund the programs and services that are so meaningful to so many of us. I want to also say that the reserve fund and the program at PNC Bank is overseen by, we have an investment committee that's an ad hoc committee of our board, comprised of people who are experts in finance and investments and fiscal management. Actually, we have a committee meeting coming up next week where we're going to be reviewing it with the bankers at PNC, and I'm anticipating it's going to go very well. I also want to point out that you can certainly be in touch with me to request, or with me or with Neal to request a calculation in confidence, and there is no obligation to proceed.
Thanks, everybody, for being part of our presentation today. We thank you very much for.
Thank you very much. And I also want to wish all of you a happy new year, a healthy new year, and may we be privileged enough to wish each other a happy new year next year again at this time.
Bye, everybody.